Thank you, Mr. Chairman. Thank you, Ranking Member. At this time, recognize Mr. Powell, the subcommittee chair, for 5 minutes.
Thank you. Thank you, Mr. Chairman. You know, we hear that in the future we're going to have a better economy, and everybody hopes so, but it's hard to believe. It's hard for me to believe anyway, because I look back on our past 3 years, and what Congress has done and what the Fed has done, we've literally injected about $5.3 trillion, and I don't think we got very much for it. The national debt went up $5.1 trillion. Real GDP grew less than 1%. So I don't think we've gotten a whole lot. Unemployment really hasn't recovered. We still have 7 million people that have become unemployed. And one statistic that is very glaring, if you look at the chart, is how long people are unemployed. The average time used to be 17 weeks. Now it's nearly 40 weeks they stay unemployed. So nothing there reassures me. And also, when we talk about prices, we're always reassured there's not all that much inflation, and we're told that they might start calculating inflation differently with a new CPI. Of course, we changed our CPI a few years back. There's still a free market group that calculates the CPI the old-fashioned way, and they come up with a figure, in spite of all this weak economy, that prices have gone up 35%, 9.4% every year. And I think if you just went out and talked to the average housewife, she'd probably believe the 9% rather than saying it's only 2%. So I would say what we've been doing isn't very reassuring with all this money expenditure. But my question is related to the overall policy. Spending all this money hasn't helped, and yet many allies that would endorse so much of what's been going on, whether it's the Fed or the Congress, they recognize that consumer spending is very, very important. And they concentrate on that. But the $5.1 trillion didn't go to the consumers. It went to buying bad assets. It went to bailing out banks. It went to bailing out big companies. And lo and behold, the consumer didn't end up getting this. They lost their job, and they lost their houses and mortgages, and they're still in trouble. But my question is, if you took that $5.1 trillion and said that consumer spending is good, you could have given every single person in this country $17,000. Why is it the program of both the Congress and the Fed to direct the money to the people who had been making a lot of money, instead to the people who, if you argue that the consumer needs to spend the money, I obviously don't advocate this, but I would suggest, you know, maybe it could have worked better. It couldn't have worked any worse. But what is the reason we direct it toward the banks and the big corporations, too big to fail, and we don't pay that much attention to the consumer if it's true, and I don't know if you agree with that or not, that consumer spending is an important issue?
Well, it is an important issue, Congressman, but you're mistaken in saying that the Federal Reserve has spent any money. You say $5 trillion. We have lent money. We have purchased securities. That's not buying, that's not dissipating, you know, the money. We've gotten all the money back. As an article over the weekend by Alan Sloan showed, in fact, the Fed has been a major profit center for the U.S. government. We've turned over profits in the last 2 years of $125 billion. So we are not costing any money in terms of budget deficits or anything like that. In terms of what we were trying to do, of course, the reason the Federal Reserve was founded a century ago was to try to address the problems arising from financial panics, which did, by the way, occur in an unregulated environment in the 19th century. We provided liquidity and short-term loans to help financial systems stabilize. We did that not because we particularly care about the managers or the shareholders of financial firms.
I hate to interrupt, but my time is about up. But I would like to suggest that you say it's not spending money. Well, it's money out of thin air. You put it into the market and you hold assets, and the assets aren't, you know, they are diminishing in value when you buy up bad assets. But very quickly, if you could answer another question, because I'm curious about this. You know, the price of gold today is $1,580. The dollar during these last 3 years was devalued almost 50%. When you wake up in the morning, do you care about the price of gold?
Well, I pay attention to the price of gold, but I think it reflects a lot of things. It reflects global uncertainties. I think the reason people hold gold is as a protection against what we call tail risk, really, really bad outcomes. And to the extent that the last few years have made people more worried about potential of a major crisis, then they have gold as a protection.
Do you think gold is money?
No.
It's not money.
It's
Even if
a
it had been money
metal.
for 6,000 years, somebody reversed that and eliminated that economic law.
Well, it's an asset. I mean, it's the same. Would you say Treasury bills are money? I don't think they're money either, but they're a financial asset.
Why do central banks hold it?
Well, it's a form of
money.
reserves.
Why don't they hold diamonds?
Well, it's tradition, long-term tradition.
Well, some people still think it's money. I yield back. My time is up.
Thank you. Thank you. This time, Mr. Clay, the subcommittee ranking member.
Thank you, Mr. Chairman. Chairman Bernanke, has the Federal Reserve analyzed the impact on the economy if the debt ceiling is not lifted by August 2nd? Yesterday, President Obama stated that VA benefits may not get to recipients and that some social security checks may not get mailed to American seniors. Has the Federal Reserve examined what may happen on another level on August 3rd if we do not lift the debt ceiling?
Yes, of course, we've looked at it and thought about making preparations and so on. The arithmetic is very simple. The revenue that we get in from taxes is both irregular and much less than the current rate of spending. That's what it means to have a deficit. So immediately there would have to be something on the order of a 40% cut in outgo. The assumption is that as long as possible, the Treasury would want to try to make payments on the principal and interest of the government debt, because failure to do that would certainly throw the financial system into enormous disarray and have major impacts on the global economy. So just as a matter of arithmetic, fairly soon after that date, there would have to be significant cuts in Social Security, Medicare, military pay, or some combination of those in order to avoid borrowing more money. If, in fact, we ended up defaulting on the debt, or even if we didn't, I think it's possible that simply defaulting on our obligations to our citizens might be enough to create a downgrade in credit ratings and higher interest rates for us, which would be counterproductive, of course, since it makes the deficit worse. But clearly, if we went so far as to default on the debt, it would be a major crisis, because the Treasury security is viewed as the safest and most liquid security in the world. It's the foundation for much of our financial system. And the notion that it would become suddenly unreliable and illiquid would throw shockwaves to the entire global financial system.
And higher interest rates would also impact the individual American consumer. Is that correct?
Absolutely. The Treasury rates are the benchmark for mortgage rates, car loan rates, and all other types of consumer rates.
Thank you for that response. In the area of unemployment, according to the Labor Department, our unemployment rate in June was 9.2%. What can the Federal Reserve and Congress do to put Americans back to work? Any suggestions?
Well, it's a difficult problem. I think I'd like to make very clear that I think we have two crises in the economy. One of them is the fiscal set of issues, which you're all paying a lot of attention to right now, but I think the job situation is another crisis. What's particularly bad about it, I think, is that so many people have been out of work for so long that it's going to be hard to get them back to anything like the kind of jobs they had when they lost their jobs back in the beginning of the recession, for example. So it's a major problem. The Federal Reserve is doing quite a bit. We have, of course, as I described in my testimony, we have lowered interest rates almost to zero. We have done additional policy measures, including purchases of several $1 trillion of securities. We are prepared to take further steps if needed. We're operating on other dimensions, like, for example, trying to promote lending to small business and other things that could potentially help. So we are very focused on jobs. We think that's an incredibly important part of the current economic crisis, and of course it's one of the two parts of our dual mandate. For Congress, it's you know, I need to be careful not to endorse specific programs, et cetera. But as I mentioned, one thing to take into account is to try to avoid sharp contractions in the near term that might weaken the recovery. I think there are areas where attention might be paid, and just to name three I've talked about before. One would be to try to address unemployment through training or other types of programs that might help workers get back into the job market. A second problem is the housing market. Clearly that's an area that should get some more attention, because that's been one of the major reasons why the economy has grown so slowly. And I think many of your colleagues would agree that the tax code needs a look to try to improve its efficiency and to promote economic growth as well. So there are a number of areas where Congress could be looking, and I hope that we'll keep in mind that we have two sides to this crisis. There's a jobs crisis, and there's also a fiscal set of issues as well.
Thank you very much for your response. Mr. Chairman, my time is up.
Thank you. Mr. Royce, senior member of the committee, recognized for 5 minutes.
Hello, Chairman Bernanke. I think one of the realities you also face is that when we look at these numbers and the deficits, you're borrowing at a historically low cost over at Treasury. You know, maybe your borrowing costs are 2.5%.